Hello and welcome back to With Sikya. In the last couple of videos, we have discussed about mutual fund investment. Now let's understand a very important concept, mutual fund return. Just a quick recap. Mutual funds are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets like stocks, bonds, or other securities. The returns from these investments are then distributed. Understand mutual fund returns can be made more intuitive with a real-life example. Let's break it down using a hypothetical mutual fund investment. Question number one, choosing a mutual fund. Suppose you choose the ABC Growth Fund, an equity mutual fund investing primarily in stocks. Number two, initial investment. You invest rupees 1 lakh in the fund on January 1st, 2023. Number three, net asset value or NAV. The NAV of the fund on January 1st, 2023 is rupees 50 per unit. Means your 1 lakh rupees investment buys you 2,000 units of the fund. Rupees 1 lakh divided by rupees 50 is equal to 2,000 units. Number four, performance over time. By July 2023, NAV of fund has reached 360 we higher. By December, fund and NAV further increased to be 70 we. Now, calculate the return. The fund value of 30 days. What July 1st, 2023, investment is multiplied by 360, which is equal. Means that you will be saying it lost the event. For investment is the birth rate. It's 1,40,000. Number two, return calculation. January 1 to July 1, 2023, the value increased from rupees 1 lakh to 1,20,000. Return piece water that helps divided by 5 piece 1 lakh in 100. Just very super. From January 1 to up, water can go spring, it's seen. You could have it, but 1,40,000. I think what it would have. 1,40,000 minus 1 lakh divided by 1 lakh multiplied by 100. What you see? Let's understand what all this means. Absolute return. The total increase in value over the year is piecewise, which is what you said of your dimensions investment. Annualized return. Get a sense of annualized return. If the investment period is less than a year, you might use the formula for compound annual growth rate or CAGR, which is more accurate for varying investment duration. Let's become familiar with CAGR or compound annual growth rate. CAGR or compound annual growth rate is a useful measure. Understand the average annual growth rate of an investment over a period of time, assuming the profits were reinvested each year. It smooths out the volatility in returns to provide a consistent measure of growth over multiple years, even if the returns in individual years vary greatly. CAGR is often used in mutual fund investments to help investors understand the rate of return generated over a specific period. The formula to calculate CAGR is ending value divided by beginning value is the power of 1 by n minus 1. Yeah. Value of investment at the end of the period. Beginning value, the value of investment at the start of the period. N, number of years the investment was held. Let's calculate the CAGR for the mutual fund investment from the previous example. Beginning value, January 1, 2023, rupees 1 lakh. Ending value, December 31, 2023, rupees 1,40,000. Investment period, 1 year. Using the formula, CAGR is equal to 1,40,000 divided by 1 lakh raised to the power 1 by 1 by the square. Then, and on the when is down. Then, and as I said, I'm doing 1%. Multi-year CAGR of that. Let's assume you had invested with what had mutual fund on January 1, 2020, and by December 31, 2023, your investment had grown to rupees 1,80,000. Now let's calculate the CAGR for this 4-year period. Very popular. In here is you 1,80,000 by the sword. Take it in, but the 8% band in place. Calculating the result, CAGR is equal to 1.511 by the sword, or 15.11%. So CAGR over the 4-year period is 15.11% per year. Some key points about CAGR. Smoothing effect. CAGR provides a smooth rate of growth, ignoring the year-to-year volatility and providing a more reliable measure over time. Number 2, comparing investments. CAGR helps investors compare the growth of different investments over time, as it shows how much an investment has grown and what happened. Number C, the invested return. CAGR assumes that any gains or income generated by the investments are reinvested. CAGR is a crucial to evaluate the performance of mutual fund over a period of time. It helps investors understand how consistently an investment has grown, and it allows for comparison between different funds or investment options. In the context of mutual funds, CAGR offers a way to measure the average annual returns, regardless of how much the market fluctuated within the investment period. Finally, let's discuss factors affecting returns. Number 1, market conditions. Equity funds are influenced by stock market performance. Number 2, fund management, the skill and strategy of the fund manager. Number 3, economic indicators, inflation, interest rates, and other funding threats, management fees, and other costs that can affect return. And he did, and that it would the follow through the information shared. If you found it beneficial, do share it with your family and friends, and give the video a thumbs up. Lastly, do subscribe to our channel with Siglia. Thank you for watching. See you in the next video. Till then, happy and safe investing.